Hey everyone, Couch Investor back to another video for you today. So today a bit more relaxing type of video. No earnings as of yet. We had a heavy earnings week last week. If you want to check out all those videos, those are going to be in the top right corner. So I'm going to put a dividend video in between two good earnings weeks because this week we're going to have Pinterest, Square, Fiverr, many others, PayPal, SoFi, Airbnb, etc. So a lot of companies to cover this week. I will cover most of them on this channel, probably 1 hour, 2 hours after the report is released. So if you want to follow that, do subscribe below and leave a thumbs up as well. But in this video, like we did in the last edition of the dividend stocks, we're going to look at 4 great companies that pay a good dividend and that have been paying a dividend for a while. Now, I know this channel talks about growth stocks a long time. In my personal portfolio, the only dividend paying company is one that maybe should cut their dividend payouts, and that's Intel. But in this video, I'm talking about 4 companies that are unlikely to cut their dividends. So before we start, if you want to support this channel, do check out the link down in the description and in the pinned comment to get the top 10 best stocks to buy now, or go to fool.com/couchinvestor and make sure to check out all the other links down in the pinned comment, some of which might actually save you some money. Now, dividend stock number 1 is Johnson & Johnson. So we'll go straight into the healthcare industry. By the way, I'm here on stockcard.io. If you want to follow this channel's portfolio, by the way, which is in the description and in the pinned comment, it's free to follow. That way you can follow along how this channel's performed. Now, obviously right now we are down, 11.5% compared to the S&P 500, and overall we're down just over 13%. That's because most of the portfolio in here is growth stock related. So let's see how we perform over time. Again, link is down, it's free to follow. So Johnson & Johnson, high growth potential, strong operations. Sentiment right now is overexcited investors. Now, with companies like Johnson & Johnson, stable companies that have gone up tremendously over time, as you can see on the graph right here actually. Basically, for a century, Johnson & Johnson has produced a compound sales growth rate of 11.6%, which isn't too shabby. Now, obviously, if you look at the dates of those comparisons, well, it's been a long time. But Johnson & Johnson is known to be a solid compounder. Now, obviously, with COVID, with everything, it has certainly helped the business a little bit, if not a lot, especially in recent times. You can see here in the past 5 years, the stock is up 31%. Before COVID, the stock was basically trading flat for a long time. But look, overall, it has underperformed the market, probably because, well, as we said, in the last 5 years, only up 31%. But then again, you have dividend payouts. Analyst consensus, 6 buy, 10 hold, 0 sell. Analyst price target, the average is at 186. Right now, the price of this stock is at 174. So not that much of an upside. But then again, you're not really looking for that much growth when holding Johnson & Johnson. So I'm going to talk a bit about their earnings report. So they reported earnings per share of $2.59. Consensus was $2.57. So they beat on that. Revenue of $24.02 billion, beating consensus of $23.77 billion. But it did cut full year 2022 adjusted APS view to between $10 to $10.10. That's down from $10.15 to $10.35. So there's that. Consumer health revenue was down 1.13%. Pharma was up 6.7%. And MedTech was down 1.1%. Now, it does have a pretty high PE ratio, all things considered, right? 25.40, so not that cheap. But it does pay a nice little dividend here, 2.47%, which is around $4.5 yearly. Now, up next is another great company, and this one is a solid compounder as well. As you can see, in the last 5 years, it's up close to 120%. It's Texas Instruments. As you can see, the card here looks very nice. High growth potential, strong operations, overexcited investors because the sentiment, well, especially after the latest earnings report, it's been good. And then again, since 2020, it's actually up quite nicely. It has outperformed the market, fairly priced stock. Then the analyst consensus, 17 hold, 8 buy, 1 sell. The price and the analyst price target are basically the same. Now here, dividend yield sits at 2.57% or $4.6 yearly. P/E ratio less than Johnson & Johnson, 19.57. And as for the latest earnings report, so they reported earnings per share of $2.45 versus consensus of $2.12, so they quite nicely beat on that. Revenue, $5.21 billion. Estimates were $4.61 billion. They do see Q3 revenue to come in at $4.90 billion to $5.30 billion. The estimates were $4.94. And Q3 earnings per share of $2.23 to $2.51. The consensus was $2.26. So quite nice on that front as well. And I do want to show you one thing from a good friend of mine here on Twitter. And that's this right here, stock buybacks. You can see this is an example, as it says here, an example of buybacks done as they should be. This is really exactly how you want a graph to look like, especially the price, the way up, stock buybacks quarterly, nicely done as well. By the way, if you don't know what Texas Instruments does, it's also in the semiconductor industry. So a quick description here. Texas Instruments generates 95% of its revenue from semiconductors and the remainder from its well-known calculators, which I have myself. Texas Instruments is the world's largest maker of analog chips, which are used to process real-world signals such as sound and power. Texas Instruments also has a leading market share position in processors and microcontrollers used in a wide variety of electronics applications. So there you have it. Now, before I go to number 3, you might say, another portfolio. You are 100% correct. This is the Couch Investor portfolio, a specific one to go into the competition we're having on this channel, which, by the way, you can also join. Link will be down in the pinned comment. It's free to enter. Contest runs until the last day of 2022. Whoever wins gets $250 in cash, and the top 5 get 3 months free VIP access on StockCard. So why not enter? It's free. And today, not many things are free. So number 3 is Walmart. Now you might say, are you crazy? Walmart? Why do you choose Walmart? Look at the chart. Fair growth stock, stable operation, all neutral here, calm investor sentiment, then has underperformed the market, overvalued stock. Then analyst consensus right now sits at 20 buy, 12 hold, 0 sell. Today's price, $132. Analyst price target, just close to $10 over that. Now in the last 5 years, the stock is up 64%, so okay. But in the last year, it's down 7%, not that much, but then again, Walmart is not really that much of a growth stock. And for those that are comparing Walmart to Amazon, please don't. Now, as for Walmart, they did give us a early earnings, let's say, because of, well, everything that's going on right now in the market, especially with retail. But then again, Amazon crushed it. I did a video on that, top right corner. So Walmart pays out 1.68% dividend yield, which comes out at $2.24 yearly. Now, Walmart said that it sees Q2 adjusted EPS down about 8 to 9%. It sees its full year adjusted EPS down about 11 to 13%. Q2 operating income down 13 to 14%. And for the full year down 11 to 13%. Q2 sales, including currency hit of around $1 billion. So that's why the stock was down after they announced that. But then again, if you look at the graph right here, we look at the 1 month, you can see huge drop, but it went right back up again last week, which, to be honest, they can thank Amazon for that. But all that said, Walmart is still America's largest retailers by sale, not by far anymore, but still pays a nice dividend. They will probably never cut dividend. There is a little bit of growth ahead for the company if they can figure their things out. Now the company has, it says here, the company operates several e-commerce properties apart from its, well, Walmart.com, including Flipkart and Shoes.com. It also owns roughly 10% stake in Chinese online retailer JD.com. So there is that. I think in the dividend portfolio, Walmart, Target, those kind of companies have a nice fit in there. And now, last one is at&t. Didn't see that one coming, did you? Now, at&t, as you can see, the chart is very, very weird. Now, it's red on the, let's say, okay parts of the chart here. So, high growth potential, yes. Struggling operations, not so good. Calm investor sentiment, underperformed the market, and it is an undervalued stock. Analyst consensus, 6 buy, 16 hold, 2 sell. Price today, $18.79. Analyst price target, the average, 22.11. In the last 5 years, the stock is down 35%, so not that great. But it does pay a very, very nice dividend at the moment. It says here dividend yield 8.49%. In dollar terms, it pays you $1.11. Now they had a nice earnings report as well. Earnings per share of 65 cents, beating expectations of 61 cents, and revenue came in at $29.64 billion, beating expectations of $29.56 billion. So quite nice there. PE ratio here of 6.9, so pretty low. Price to sales ratio under 1, very, very rare. But free cash flow positive, yes, tremendously. Now again, yes, with the low PE, we've seen what that means with Intel. But unlike with Intel, earnings per share for at&t are not decreasing 70% year over year. It's a very, very solid company. And again, such a nice dividend. In a dividend portfolio, you do not want to skip over that one. So there you have it. Those are the 4 dividend stocks for the month of August. Now again, my portfolio is mainly growth stocks besides that Intel one. But if I were looking to build a dividend paying portfolio, those 4 companies plus the ones we've talked about in the last video would probably most likely make the cut. Very, very solid company, solid business, probably never going to cut dividend payouts. So that's exactly what you want in a dividend portfolio. Remember, coffee can portfolio, dividend portfolio is probably a good example for that. Put some money there, you close it, you put it in the closet, and then 20 years from now, you look at how much it has grown. Obviously, do share your thoughts down in the comments below. Did I miss some great dividend-paying companies? Leave it down in the comments below. And if you enjoyed this type of videos, leave it a thumbs up. If you aren't subscribed to this channel, maybe hit that subscribe button. And I see you all in the next one. Bye-bye.